So today we'll be talking about the index coming closer to a major crossroad. This is the 7100 level, and we feel about this junction we're going to start feeling some heavier motions into some corrections into stocks. We've had a lot of blue chip actions lead up into where we are today, and we're going to have to be able to go through a number of them to be able to try to be able to figure out whether we should be lightening down or taking some profits, or whether we should be holding our positions despite some of the cascades that we'll be seeing into our market conditions. So let's begin first by seeing what happened into the market so that we can better understand where we are coming from as a baseline. So in the beginning of the year, we were talking about a potential move that the index could do to try to break over a 6,700 resistance. This was a very crucial spot for us because this 6,700 area was right here where you see this red arrow or line is. And we said that if we had broken through this essential downtrend line, that would be able to improve our technical condition and allow us to be able to seek out higher levels of resistance. The next levels would be between 7,100 and 7,500. But I don't think that we'll do this all in one swing. We may have to be able to do this as a up and down swing movement, and that's why we've labeled it as an S-shaped recovery, as it will seem to be sneaking itself upwards. And as we come through the first major hurdle, we're going to be able to see some volatility into the market condition. Now, another reason why we feel that we've managed to be able to break a critical junction is if you look at this chart I have here of the index, it's a long-term chart way back since 2015, 2016, and we've had the high made in 2018. We haven't really seen the market come up to be able to generate some sort of heavier activity on the upside. But recently, a major downtrend line has been broken. This is that area that lands at 6,700. And that little slip up might look small to you, but I think it is quite essential, gave us further proof that the market was indeed generating a major bottom since the two bottoms you saw in 2022 and the last one we saw sometime last year in 2024. And because of this, we feel that the new bullish swing is engaging itself. And now we're just going to have to learn how to be able to deal with a little bit more of whatever bearish sentiment is remaining before we can come back into a market that might show us a little bit better upsides. Now, the reason we also feel quite good about this is because, and I think I've shown many of you this before, is that after a major bottom has been established in our history, the index has always made its way back up into a new high. And given the fact that we feel that we've generated one back here during that pandemic low, we are just now into our initial motions of coming off an initial bullish phase again. But during this phase, we don't expect very rapid movements because there's still remnants of bearishness out there, and we could still get hit by pockets of macro threats that could come out, whether it's on rates or whether it's on inflation. It will take a little time to be able to groom it, but at least the worst is over, and that all we are doing is trying to expect for more upside to come out in a not so long period of time anymore. Now, to be able to scope out another essential market, and I'll go back to the Philippines later though, but let's look at this market first. It's important to be able to assess movement into the S&P 500 or the NASDAQ because they've kind of been leading a lot of markets across the world into the advances that we've been seeing. We're not the only market that managed to make recoveries. In fact, some other markets have made very much extended recoveries, more than what we had back here. But in the S&P, since this is a leading indicator for us, we've noticed a very sharp movement into the S&P 500. And going back to this model that I've been following quite for some time now, we seem to be coming towards an area that might generate a temporary high that might cause some corrections down the corner. And it's really because of that that we feel that we might see some increased volatility or corrective action into this market phase that we may have to be a little guarded against. Now, although that might show some corrections, I feel quite confident that we're not going to see an implosion in price or a turnaround in trend. What we will see, though, is you will see cascading movements like the way you saw here back in 2005 to 2006, where you see that the US market was going up and down, but generally higher. And I feel that the same type of movement might also turn out into the US. But we are coming from a major high, so we may have to be able to prepare some short-term corrections that might influence markets such as ours. And it is to that we are looking at an S-shaped type of movement from here on onwards. So again, the sense of bullishness that we have really corresponds to not just one market making an essential climb, whether it be the US. But if you look at the chart that I have here, I've managed to be able to pull out a performance chart of quite a number of markets since the lows that we generated last October. And if you'd notice that, you can see that quite a number of markets have actually generated good returns, with Japan leading it at about 26%, followed by the S&P at about 23%. And we stand somewhere in the middle. We've done about 14% overall. And yes, there are some markets there that are not yet following suit. We've got the likes of perhaps Shanghai, Thailand, and Hong Kong being amongst the weakest of them all. So I would say that although a number of markets are generating relatively good upward performances, there are some pockets of weakness, and that might also tell us that we won't want to be there for the time being, and that we want to be able to concentrate our efforts on those markets that are generally showing us very good readings as well. Now, let's talk a little bit first about some of the threats that can still be encountered as of this point. Now, one of the things we've been listening to in the last 2 years really was a threat that we've seen on interest rates as scoped up by the threats of inflation. And those particular types of threats, although they've managed to be able to come down quite a bit last year, we're starting to see some advances again in certain types of commodities, not on a very broad scale yet, but there are pockets of some rallies that are taking place. And for example, gold has managed to be able to climb up quite well, breaking out from a range over here. Copper, this just happened a couple of days ago, broke out of another pattern. And although these may be a little inflationary into their signals, I think this is doing because economic activity remains relatively good. And also because of that, oil prices managed to also show recovery, not as aggressive as what we're seeing here, but it is coming off from its lows at about $68, and maybe it will work itself up, maybe somewhere closer to about 82.50 or 84, that being the next level of resistance for oil. And another concern a lot of people have been having is actually rice prices, because it's been on a relatively upward path. Although in the last couple of weeks, we did see some little bit of corrections, but it still generally points upwards and could also contribute to the inflationary stand. Now, to be able to get a sense of whether markets seem to be worried about much of the threats that we're looking over here, let's actually look at inflation and let's look at bond yields, because bond yields will move in correspondence with any threat that inflation is imposing upon us. So if you look at the inflation rate, we start first in the US, there's been a little bit of an uptick in inflation, and this is the reason why we're seeing a little bit of some recovery into bond yields as well. But it looks like the rally we're seeing in yields is probably going to be climbing up in a controlled manner and not too excited, with perhaps the next level of resistance between 435 and 450 being maximum rate that perhaps it can generate. So if it can just climb up to there and then come back down later, I don't think that will place too much risk on our areas as well. If you look at the Philippine version of this, also inflation rate managed to be able to generate an uptick. But remember, this is coming off 1, 2, 3, or 4 or 5 sessions already that have shown some tapering. And it's not normal to have a little bit of these upsides every once in a while. A look at the bond yields of the Philippines, you will see that a little bit less aggressive than what we saw into the US. In fact, it just actually broke a little bit of support on the way down, which means that it doesn't seem to be too worried as of yet with this little uptick that we've seen in inflation. And that kind of tells us that it doesn't seem to be too worrisome as of yet. And being so, I think what we can do is we can put a dampener into whatever potential inflationary risk we have for now. And we'll just keep you updated to see if there are any changes that come along the way. And if they are, then of course that will also be included into our next market outlook for you. But as it stands, so far, it doesn't seem to be worried about it. Now, another thing I also want to be able to point out is the movement between some of the currencies, particularly the dollar. And the US dollar has been coming down a little recently, but is still coming around into a particular area pattern here. And I think there will be a time for it to be able to narrow off into this range. But my interest over here is because of this chart that you see on the right side. This is a longer term view of the dollar. And so far, what I see over here seems to be what is known as an ABC type correction for the dollar. And we are just maybe coming to complete what is known as a B wave, or this little rally wave that you see here. If that is, and it continues to correct later on, the potential for it is to come down, break support, and maybe come down closer to where this C level is. And if that happens, that will lend a lot more strength to the peso as well. So if you look at the peso chart that we have here, you notice that also we've been seeing a firming up in the peso. But so far, it's managed to be bounced on major support at 55.25. And that means that for now, we're holding this horizontal slant. And perhaps it can just cascade within this particular range for the meantime, between 55.25 and 56.27. But we are leaving some space open for a potential support crack of this 55.25, just in case we see more weakness come here. In that case, then we can see the peso maybe even firm up to something like 54.60, that being the parallel of this downtrend line that it so far have made. Again, looking at the weekly chart of the peso dollar, you will also see the same, an A wave, a B wave, and a potential C wave in manufacture. And again, if that happens, and that means there could be a bit more firming up for the peso to do down the road. Now remember, this is a weekly chart, so whatever you see here might take a little longer time to be able to build up to. But for now, since it's at major support, perhaps a recovery into this dollar peso rate first, and perhaps this should make another lower high, and then we'll see whether it will re-engage its support threat once again. So what can we expect given some of the things that we talked about so far? So going back to the PSEi, the PSEi is now in a situation where it's climbed up since October, and it's gone up to our first major area of resistance, which is closer to 7,100. And along with that, it finds itself a little bit stretched, and we've started to see quite a number of mixed movements along its members. In fact, 15 of the index members are still treading on an upward path, which is obviously good, but the other half are really starting to show some pullbacks, some consolidations, and that is sapping the momentum of the rally. And it is because of that that we're noticing that you're seeing mixed swings, getting sideways patterns. We're seeing increased volatility. And this volatility normally comes in on major tops or major bottoms. So if we're seeing that volatility right now, all that simply means that we have to be able to be quite prudent in what we're doing, tone down our aggressiveness, in fact, maybe raise some degree of defensiveness, just in case we're going to see these sudden or very short-term blips that might cause broader stocks to be able to pull back down. And thus, we have to be a little bit more watchful of these situations, and that might also ask for a little bit of lightening, of which I will talk about that in a little bit. So here we are in the PSEi index, and we saw what happened today. The index was down quite a bit, 145 points, and you can see a very mean streak on this red line here, but it still stays inside this consolidation band that it has kept itself on for the last few weeks. And this is very normal. So normally when an uptrend comes, before it turns its trend or decides to be able to push either up or down, it normally enters a small consolidation or sideways range first. Excuse me. So right now, we are stuck in this crossroad where we are within a range of 6,780 being support and 6,980 being resistance. So in order for us to continue the upward path, we will have to break the 6,980 so that we can come closer to that 7,100 or 7,130 where this parallel currently is lying for. But if unfortunately the index breaks 6,780, and looking at what we saw in today's action, there's quite a good chance that that could happen, then we may have to be able to prepare for the index to be able to back off a little bit more and maybe even see our next levels of support. So what would that pullback look like? So if you look at the chart I have here on the lower right side of my screen, I have the two scenarios. The strong one is we get a pullback here, something like this, and then it holds at support, rallies back to the previous high, maybe even break it a little bit, pull back inside, make a higher low, and then climb up again. Obviously, that is the much better scenario for us to see. However, I'm leaning on the second scenario, where we'll probably get this kind of movement, the movement we see today, a little bit of a rally, turn down without breaking the previous high, and then eventually crack 6780, and then skid down to do what is known as an ABC wave, and that complete the potential correction of our market. What are we looking at support? A range between something closer to 6.6 or 6.580 being the first level, and maybe 6.5 or 6.450 being the next level of support. So these are the areas that we'll probably look at for potential buybacks if we've taken some of our profits from here. And if we can see basing formations come to generate themselves here, then that can be able to give us a much better signal to start gradual buybacks in some of the favorite issues that we've managed to be able to trade in recent weeks or months. So some of you who've been reading our tech spotlight or my tech spotlight have managed to be able to see that I've presented two options into the short term. So what do we do when you see this volatility? Do we just completely sell everything and hide? Well, you don't have to sell everything, but you may have to choose on which way or strategy you'd like to be able to place yourself on. So the two types of strategies that we'll have here, the first is what I call the bird in the hand. This is usually a statement that says, if you get that opportunity and a bird lands into your hand, you can finally take it and at least have that prize because it's finally with you already, right? So when you say a bird in the hand, that normally means it's a short-term opportunity that you have. Take the profits, right? So that you can come around and realize the benefit of that. So since we are, however, still in a relatively advancing market, you don't really have to be able to completely empty your coffers. So my suggestion is to be able to whip back maybe about 30 or 50% of your portfolios, especially on those issues that I will point out in a little while that are exhibiting certain types of characteristics. Number one, those that are showing very overbought levels or exaggerated movements. To give an example, here's an example of SM. If you see that in the last few days, it just went up, up, up and away, and it actually hit a secondary target that I was looking at, which is closer to about 1,000. So if you can also see the channel that I have over here, you can see it's on the upper band of the range, not on the middle or the lower part. So if you see prices do this, and there's a potential, just like the way it did here, to be able to whip back closer to support. And given that condition, we're now in an extreme or exaggerated situation, and this might be an opportunity. We have to take some profits off these issues that manage to be able to give us a good run in a very short period of time. Now, another trigger that you can use to generate a signal to profit take is if you see cracks into what we call short-term moving averages. Normally, we can use a 10 to 20 day to be able to suggest those types of averages. So if you have a 10 or 20-day EMA or exponential moving average, drawn here in violet and drawn here in yellow, so these crack while prices are falling down, that can give you also a confirmatory signal that it's time for you to take some profits first because prices seem to be moving backwards and that you want to use that opportunity to lighten your position to these ratios I've talked about here so that just in case prices do fall back, you have enough cash to be able to buy back at better levels later. Also, to contribute to that is if you feel that your downside capacity, in other words, measuring from where you went from the top, going to your next level of support, this one or this one, is greater than about 5% or more than 5%, then that should help you also make an assessment that this might be a right time to profit take so that you can sell it first and you have room to buy back later, assuming that you have that 5% spread onto those levels of support. Because if you sell here and you only have to be withdrawing by 1 or 2%, that really doesn't give you too much threat and might not give you the opportunity to buy back at a decent price. right? So we want to make sure that the downsides are clear and manifest for us so that just in case we do get wider corrections, we have an opportunity to buy back at a good range that can allow you to make it much more efficient in terms of moving out and then moving back in. Now, when do we buy back? Well, we buy back when we see that option where prices fall back to the established levels of support. Let's say in this case between 950, 926, what I pointed here for the meantime. And if we do see that prices seem to be rebounding from major support like this lower one here, then that should be able to give us a bit more confidence that you can start your buyback campaign. Now, remember, you don't have to buy everything back in one go. You can buy this in one or two tranches just to make sure that you can feel your way through, to make sure that the market seems to be holding at those areas of established support. Also, I do expect that markets will come back down into a threefold wave or an ABC. So if you see your first pullback from something like this, that may not be the pullback that you want to buy back to. Allow it to fall back once, rally first, and then a second decline, and then that should be able to give you the ABC that you're looking for. So let me give an example. If you look at what happened to SM the first time around, here's the major top. Here's the first pullback, that's your A wave. Here's your first rally, that's your B wave. And here's the third, and that's your C, and that's where the base comes in before the recovery comes in. So this is what we want you to be able to look out for. And finally, the other thing that can key you back in is just in case prices decide to just go sideways instead of falling back down too much. If they build a pattern similar to what you see over here and they break out, then the breakout can trigger a new entry for you as well. So you can use any of these three reasons to establish your new positions into that condition where you take some profits now and that you have an opportunity to buy back later. Now, the second option you have would be let's presume that the market's not going to fall down too much, and I'm going to decide to hold it through. Now, this is an important decision you have to make, and you have to make it early. And the reason for that is because if you make this decision to hold or sell very late, then you might not have the ability to widen the spread of your pullbacks later for you to buy back. So in this particular case, if you think that the pullbacks here might not really be too wide, then you can just say, all right, any small blips into the price, you won't really worry about. So what you can do is say, I'm holding as long as I don't see, let's say, prices break below their 50 or 100-day moving average. That's a strategy you can say as a longer-term hold. But if you do see these moving averages break, then that tells you that more likely we're going to see bigger downsides into the correction, and that itself tells you it might be best that we lighten our positions because of the cracks of such support areas. And so here, that hold is still protected by some degree of a safety net. It cannot be that you're open-ended in here because it's very difficult to say that this may not go all the way back down to the low. Things can happen, things beyond our review could happen, and we have to just make sure that we are always grounded and protected in case something like that happens. Now, we want to be able to buy back when we see prices rebound from this 50 or 100-day moving averages as well. That tells you that there's inherent strength and resilience, and that they could just build a pattern, then maybe later try to be able to break out. But keep your eye on these 50-day. In this case, it's at this price for BDO, and in this case, this is your 100 days. So cracks of this and this should be able to tell us, okay, a wider correction is coming. Let's back off first. Okay, so it's up to you which two options that you can choose from. Personally, I've been taking the first one because I've been noticing a lot more volatility, and that generates, I think, a lot more vulnerability of the market. And it's because of that that I think that it's quite prudent that maybe the option one might be a better choice. But for those who are a bit more longer term than I am, you can always come around to be able to do the lower support as your protective device and get stopped out in case something like that happens. So just to recap, so looking at the things that we've studied so far, the Philippine technicals, although yes, it's stretched, but it's clearly better than what we've come from last year. And it looks like we've ended the bearish drift, and that's very important. But because we've had a November to March recovery of a generally good amount, coming back closer to that major resistance of 7,100, it looks like the index needs to be able to generate a correction or to coil downwards and fix up some of the extendedness that they've managed to be able to show. After that pullback, I think it will base out again and show a higher low and then move to be able to target either the 7,100 or the 7,500 that we were looking for as targets for this year. In the US, I still see a very strong market, but similarly, it is also just a stretch, if not more stretch. And because of this, it will keep open any threats of short-term corrections or a consolidation that could be around the corner. Now, again, as I pointed out earlier, I think what it will do is generate a correction, but it will not break the upward trend that it currently has. So it will come back down, generate a higher low, and after that, try to impact another recovery wave from it. Now, commodities, which I pointed out, yes, there is some degree of threat in here because we've seen some advances in some key commodity groups. And it's because of that that I marked this as yellow, because I'm quite neutral there, not bullish on it. And I'd like to observe it a little bit more to see if it's going to push up more or whether it's just going to halt where it is. Because if it is, then it might not play out too much of a threat. But if it does, then we'll have to be able to condition ourselves that might prolong the ability for inflation to come down and whatever impact it may generate for rates to come down sooner or maybe even longer. So inflation did have an uptick, and that's what caused yields to be able to make a little bit of a recovery. But like I pointed out earlier, it doesn't seem to be too worried yet, and this may have very limited upward space for yields. And by that argument, there could still be quite conditioned to what people are quite expecting, that we may have a rate cut in the US sometime closer to either the late second half or third quarter of this particular year. Now, in terms of the dollar and the peso, we might be seeing a little bit of rebounds for now, since some of them are at support. But the longer-term picture does suggest that there is room for weakness into the dollar, which could help the dollar-peso rate if that particular dollar breaks major support. So it's something that could add also positive stream into us.